Hey savers, and welcome back to Save It, where we make your money work harder. Please remember, this video is for entertainment purposes only and is not financial advice. And today, we've got some huge news for anyone with student loans. As I promised in the last episode, today we're going to explain the WRAP plan in details. If you thought navigating student loan repayment was already a puzzle, get ready for a whole new set of pieces. Congress has just passed what's being called the Big Beautiful Bill, and it's shaking up the entire federal student loan landscape, especially with the introduction of something called the Repayment Assistance Plan, or WRAP. Now, for many of you, the SAVE plan has been a lifesaver. It offered significant relief, especially for lower-income borrowers. But here's the headline. The Big Beautiful Bill immediately eliminates the SAVE plan. Yes, you heard that right. So what does this mean for you? Let's break it down. What is WRAP? WRAP is designed to simplify repayment options, particularly for new loans. Instead of the way SAVE shielded a big chunk of your income, WRAP looks at your entire adjusted gross income and charges a small percentage. Here's the tiered structure. If your AGI is $10,000 or less, you'll pay a flat $10 a month. From $10,001 to $20,000, it's 1% of your AGI. From $20,001 to $30,000, it's 2% of your AGI. And it continues to climb 1 percentage point for every $10,000 bracket, capping out at 10% for AGI above $100,000. One crucial detail: no more $0 student loan bills. Even the lowest income borrowers will have that $10 minimum monthly payment. But like SAVE, WRAP does cancel any unpaid interest each month if you make your required payment. This means your loan balance shouldn't grow, which is a major win. And after 30 years, that's 360 payments. Anything left is forgiven. Plus, WRAP subtracts $50 per dependent from your base monthly payment, and if your payment doesn't fully cover interest, that interest is waived, and up to $50 of your payment can go directly to your principal, helping your balance shrink. This is a nice feature. WRAP versus SAVE side by side. Let's get to the nitty-gritty comparison because this is where many of you will see the biggest difference. SAVE disregarded the first $35,000 of income for a single filer, making it very affordable for many. WRAP, however, doesn't ignore any income. While its percentages start low and rise gradually, you'll likely be paying more each month under WRAP than you would have with SAVE, especially at lower and middle incomes. Look at this table. At $25K income, SAVE was $0, WRAP is $42. At $40K, SAVE was $40, WRAP is $133. Even at $90K, SAVE was $457, and WRAP is $675. For many, these are significantly higher monthly payments. The $10 minimum, small number, big change. About 70% of borrowers in income-driven plans have qualified for a $0 bill at some point. WRAP ends that safety valve. Supporters say this token payment keeps borrowers engaged. Critics argue that $10 still matters to families already struggling with basic necessities. If you're used to a $0 bill, start planning for $120 a year under WRAP. Set up automatic transfers and make sure you recertify your income annually so you don't accidentally get pushed above that $10 floor. Stricter rules, deferment and forbearance. SAVE offered struggling borrowers various off-ramps, including $0 payments and multi-year deferment of forbearance. Under WRAP, while payments might be low, it removes those long deferment windows that protected your credit during prolonged hardship. Administrative forbearance is still available, but the flexibility for unstable income is significantly reduced. This means more borrowers could end up in delinquency or default if they face sudden financial difficulty. Forgiveness, from marathon to ultramarathon. Under current plans, debt is forgiven after 20 years for undergrad loans and 25 for grad loans. WRAP stretches that clock to a flat 30 years for everyone. That's an extra 5 to 10 years of payments, potentially thousands more dollars, and a higher chance you'll pay off your loan before any forgiveness kicks in. Public service loan. Forgiveness still works the same, 120 payments, but your individual payments could be higher, potentially leaving less to forgive at the end. So, unless you're aiming for PSLF, think of WRAP's 30-year write-off as an insurance policy, not your primary payoff plan. Grad school and borrowing limits. The Big Beautiful Bill also brings significant changes for graduate and professional students. Grad plus loans are eliminated, and new lifetime borrowing caps are introduced. For example, medical students who routinely borrow over $200,000 today might need to explore private loans to cover the gap. These private loans won't have the same income-based payment options, PSLF eligibility, or federal discharge protections. If you're heading to grad school after July 1st, 2026, or if you're a parent considering PLUS loans, you must price check your programs now and look into scholarships, employer assistance, or thoroughly researched private loans. 5 things you can do right now. RAP isn't available for enrollment just yet, but it's the law. Here are 5 things you can do to prepare. 1. Estimate your RAP bill. Use the income bracket table we showed earlier to ballpark what your new payment might look like. 1. Consider shrinking your AGI. Pre-tax retirement contributions like 401k, IRA, HSAs, and even filing taxes separately if married and it makes sense for your situation can lower the income RAP uses for calculations. 1. Keep PSLF paperwork up to date. If you're pursuing public service loan forgiveness, make sure all your employment certifications are current. Higher payments still count, but missing forms can erase credit. 1. Borrow carefully after 2026. Any new federal loan taken out after July 1st, 2026, will pull all your existing federal debt under our app's rules. Calculate the return on investment carefully. 1. Download payment records now. Having proof of past payments is crucial, especially if there are any changes or transitions. Think of these as free insurance. If our app goes through, you're prepared. If it stalls, you still have a healthier budget and better organized loan files. Final thoughts. RAP aims to simplify student loan rules, but for many, it will mean a tougher road, higher minimum payments, a longer path to forgiveness, and stricter borrowing limits for graduate school. The interest waiver is a good feature, but most SAVE users will still pay more for longer. The takeaway? Don't wait for these changes to hit. Start crunching your numbers, organize your paperwork, and mentally prepare for potentially larger payments. Being prepared means you meet these new rules on your own terms, not in a panic. What do you think about these changes? Are you a current SAVE plan user, or are you looking at new loans? Let me know in the comments below. Don't forget to like this video, subscribe to Save It for more financial insights, and hit that notification bell so you don't miss our next video. Thanks for watching, and remember, when it comes to your money, save it.